Hi, welcome back. Please like and share and subscribe and consider donating so we can keep this content going and comment below your thoughts. This module is a continuation of the philosophy behind technical analysis. Last time we discussed the concept of the self-fulfilling prophecy. Today we're talking about random walk theory. Random walk theory in essence is the idea that past prices do not have a bearing on present prices, and that prices of a good or service fluctuate randomly around its intrinsic value, that there's no pattern and no way to perceive the pattern. Indicators are not truly helpful and only fulfill the self-fulfilling prophecy which we spoke about in the last video, and that the best option is to buy and hold whatever it is you purchased. This is popular amongst a lot of pundits that you see on the news. And in a bull market, it works. But we are not always in a bull market. And when you view the stock market on a long-term timeline, say 100 years, you can see there's considerable amounts of time in extended downturns. This photo is the Dow Jones Industrial Average on a 100-year timeline, log scale, inflation adjusted. This data is available for free on macrotrends.com. So as you can see, there's large amounts of time where it seemingly goes up for a little bit and then down for a long period of time. But let's take another look. So here's the non-inflation adjusted chart. This shows how much inflation we've had and shows that you can't always trust a chart because it would appear that we have had near constant gains since the 1940s. But in reality, inflation adjusted, there have been some large downturns, as we saw in the last chart. It's the exact same chart. One's inflation adjusted. This one is non-inflation adjusted. Now back to random walk. So there's a few issues with this theory. First, the assumption of intrinsic value. What is intrinsic value? Is it not the price that is set in the market? Does anything besides food and shelter and water have intrinsic value? My favorite commodity is silver, and many people argue it has intrinsic value in its ability to produce other byproducts. But again, the intrinsic value is set by the market, which is set by volume and price, set by the individuals and organizations in the market, i.e. the market action. Since the price and intrinsic value is set by the market participants, the intrinsic value cannot be considered random. Since the intrinsic value cannot be considered random, then the seemingly random fluctuations in and about the intrinsic value is actually the competition between buyers and sellers. Sellers trying to sell at the highest price possible, and buyers trying to buy at the lowest price possible, and them meeting in the middle. Given what we know and understand about market action, and that it is the study of mass psychology of the participants, the price cannot be random and does not fluctuate randomly, but as a specific function of the market action. Therefore, indicators that alert you to sudden changes in volume or bid or ask price spreads are not self-fulfilling, but a leading indicator of changes in the psychology of the market, which means it is info you can use to make informed decisions in your trading. Since these changes are caused by participants acting as buyers and sellers, it cannot be random. And it is in fact a predictable pattern that can be identified and acted upon. This is the essence of technical analysis, and it completely rejects random walk theory. This is why you're watching this video, to understand technical analysis and the philosophical issues behind it and what it means. I hope you enjoyed the concepts we discussed today. Please comment below with your thoughts. We'll explore this concept more in future videos, and in our next video, we'll be discussing Dow theory. I hope you enjoyed this video. Please like, share, and subscribe, and consider donating to keep this content going. Have a good night.